to bring in Diane because I just wanted to ask her if she thinks that the categorization of different transactions which make up someone's credit score, does that need to change? What is your opinion on that?
In relation to using open banking data, particularly for the customers we see, I think that there is some work to do, especially when we've kind of looked at the use case in the last 6 months. There are so many great ways that this can be used, but all of them rely on having what I would call good and relevant data. We find that many of our low-income customers we see are not using their bank account as conventionally as a mainstream consumer might do. The way they choose to manage their money and pay for things leads to some difficulty in accurately categorizing the transactions. We use the 12 months of open banking data to help get that wider view. And we're looking at that. I spoke earlier about the state where a customer is at the point of wishing to borrow and looking at that, what state are they in there? And then the trait, what are their usual financial characteristics and behaviors over a period of time? And what we're really looking for there is, are they in distress, or are they looking genuinely to cover and spread the cost of something over a period, and then taking a view on the how we should underwrite for that. Trying to build an income and an expenditure statement, so an I&E, from data has presented really 3 main barriers for us with categorization of the transactions that are shared by the banks. Our open banking partners, they tell us that vendor ID, transaction code, and vendor address specifically are 3 things that are not included in the data set at the moment. So the categorization is made using the transaction description, which can be variable between banks and or can lack information. So it's creating a gap really between what is being achieved and what could be achieved in terms of being able to categorize expenditure for people who don't necessarily pay everything by direct debit or paying their bills in a conventional way. So 3 main barriers: income related. If somebody's working part-time, and they might be working part-time on a couple of jobs, small and variable income, for instance, for part working, being categorized incorrectly because of there's often value thresholds placed on this transaction type, and it can mean that income can be missed in the underwriting assessment process if you're doing it all in an automated way. Secondly, cost related. Many costs and regular expenses are not categorized because of how consumers pay for them, as I've said. So if you go and top up your utilities at a post office or your local corner shop and use your PayPoint card, it's not going to show as specifically as I'm paying my gas bill or I'm paying my electricity bill. And we find several of those kind of fixed costs are hidden like this. Well over about 50% of our customers' household spend is still conducted in what I would call non-bank transactions in a significant number of the cases that we see. Finally, and probably the most challenging to solve, is transfers related. So a number of our customers use one account to receive their main source of income and then make transfers between another of other accounts. So they might be jam jarring money for bills or to contribute to bills that are paid by somebody else in the household. And without finding a way to almost subcategorize those transactions, it can make it difficult to, again, construct an accurate view of both the income and expenses. So lots of open banking providers tell us we have a lending dashboard for the I&E for you. But when you actually drill down on some of the key parts that I've highlighted there, they don't work for customer segments at the moment, mainly linked to that variability on the categorization on the transaction description rather than the vendor ID and transaction code. So even with some very clever algorithms, and there are some clever algorithms out there, the structure underpinning the data actually needs to be extended to sharing those 3 other bits of information. In addition to the, almost what is the current scope and legal requirements for banks to share. So I think doing this create an opportunity. We're talking about financial inclusion today. It will create absolutely a greater opportunity for inclusion and being able to get, Tim's advocating for, using this it's compulsory, it's got to be structured in the right way so that we don't leave people behind again with another kind of financial assessment system that's introduced. So yeah, that's the issue with categorization for us, and it's a really important part for us to be able to use open banking effectively.
Sorry, Gareth, did you want to come in at that point?
Just want to amplify what Diane's sharing there. The use case for that greater level of detail, both in terms of what the banks are required to share, but also in terms of how it's interrogated by the third-party providers or the end users of the data. Building a budget that the user understands, recognizes, and believes in is pretty important too. I don't think you should just run your own algorithm and end up with a yes, no, will I lend, won't I lend. I think being able to produce them does this look like you? If you pin this on your fridge, would you be able to live by this budget? Do they recognize it? I think involving the consumer is incredibly powerful, but also the use cases. If the opportunity to lend in an affordable way to a sector of society that really needs it is the business case to get this data and categorization, as Diane calls for, there are use cases into less profitable but just as important financial inclusion worlds, like in terms of debt advice. In the debt advice world, the standard financial statement, that's not a lending decisioning tool, requires a deeper level of categorization than affordability simply does in terms of lending. But of course, the same problems that Diane and Tim will see, the minute you take that money out of the cash point machine, was that on food or fags? And does it matter to you as a lender? Because it matters to you as a debt advisor. The minute you bought something from Tesco's, was that food or fags? Because it matters to you as a debt advisor. And so that level of data will help in those use cases that are less easy to work out a business case for and justify investment. If the business case that Diane's making, I can lend to more people more accurately, more effectively if this data opens up to me. My hope would be that use case drags across all areas of financial inclusion to benefit more people than simply those who can be lent to.
You need to kind of have a lot of infrastructure. It is really complex to get kind of multiple data sources. But in the same way, I believe that you had Moore's law from a chip perspective in order to get computational power to accelerate. I do think we're getting exponential in terms of, how quickly we're able to assess data. So I'm hopeful, hopefully my children don't ever need this, right, type of services in terms of being, in that kind of vulnerable category. But at the same time, when they do get in their, kind of early 20s, if there is another situation like the one that we're in right now, and people do need kind of other lenders and stuff like that, my hope is that within the next 5 years or so, we'll be a lot better in terms of how we categorize. Now that creates a window of opportunity right now for people to invest, for people to understand, for people to build the right kind of understanding of that complexity in order to serve both the customers and the lenders on that front. But I do believe in 5 years' time, companies like TrueLayer and others that are working on the infrastructure side will get better and better in order to enable lots of startups, lots of lenders, lots of intermediaries, and eventually the mainstream lenders as well, in order to kind of make it more profitable to be able to lend to this category as well.